So, in today's Cheeky Trading, I'm gonna be talking about a specific set of indicators which are the oscillators. More specifically, I'm gonna be talking about the RSI or Relative Strength Index and the Stochastic RSI. I'm briefly gonna explain how to set them up on TradingView, how you can actually trade with them, and how they are affected by the different time frames. So, if you're curious about this, just chill and keep watching. Hello everyone, how's it going? Welcome back to my channel, and this is your host, the Cheeky Entrepreneur. So the first thing that I want to do, just as usual, is demonstrate how you can actually set up this indicator. So the first thing that you're gonna do is going here to indicators and strategies. So you're gonna only write RSI in this case, and here you're gonna have the relative strength index. So you're just gonna click in there, and usually you will have the most common way or standard to use it, which is gonna be basically having a length of 14 and as hours to close. So this means that the indicator is actually gonna use the 14 candles before that price action, and it's gonna measure the price action when the actual candle closes. So I just want to explain briefly what the RSI or Relative Strength Index is. So it's basically the measure of the magnitude of the recent price change over the length that you choose, in this case over the 14 hours, because we're on the hourly chart. And this is very important because these indicators are gonna be dependent on the time frame you use. And I've said before, the longer the time frame, the more resilient and the more consolidation you're gonna have in price action. Thus you will have more reliability with higher time frames. So now here that you observe the RSI, basically you're gonna have an overbought and oversold position. So your price is gonna be overbought whenever it's beyond this 70 level, and it's gonna be oversold whenever it's below this 30 level. And again, this is very important because this is gonna depend on the time frame, because you might have an oversold or overbought price at the 1 hour chart, but if you go to the daily chart, that might be another story. So you have to take in consideration this. So as every other indicator, you actually have a formula behind it, and if you actually want to know how to actually calculate this RSI, what I would recommend is do your own research. You can always go to Investopedia. It's a very good source to get all the information about trading and investments. And for instance, here you can see the formula for the RSI. So I'm not gonna go very deeply into this, but you can do it in your own time. So now that I've explained what the RSI is, let's go and add up the stochastic RSI. In the same way, you're gonna go to the indicators and you are just gonna choose the stochastic RSI. So here in the similar fashion, you're gonna see that the most common settings that are used is gonna be given by the default, which is 3, 3 and 14 and 14, which the two 14s go back to the RSI chosen before. So you should be all set to go with these actual settings. So now I just want to explain a little bit about the stochastic RSI, and this is basically a momentum indicator. So it's gonna tell you whether there's gonna be more momentum to the upside or to the downside. And if you see just similar to the RSI, you're gonna have an overbought level and an oversold level. So for instance, here whatever is above the 80 level is gonna be considered overbought, and whatever is under the 20 level is gonna be considered oversold. And just before anything, I would like to say that the stochastic RSI is mostly a verification indicator, and it's used to verify whether the price is at a certain point or if it has momentum. I would personally never trade with the stochastic RSI alone, because usually you will have a very quick swings to the upside or to the downside, but still the price can be moving just to one side. So before just showing you how to use these indicators into actual trades, I just want to show you how they behave within the price action. So for instance, in this particular scenario, we see the RSI is overbought here, and we see that the price movement actually follows, and the price goes down just as the indicators goes down. But it's very important to understand that the indicator follows the price action and not the other way around. and this is essential because sometimes you can see that the indicator shows that this is well oversold or overbought, but the price action can still continue going up or going down into the opposite direction. So in this particular scenario, we actually see that the stochastic RSI is also overbought, and therefore there might be more possibility of the price actually going down because you have these two indicators aligned. But nevertheless, what I just said is true. These indicators don't mean that the price is actually gonna go down, because these are just an output of a formula where the price action is gonna be the input, so they're always gonna be following the price action. So now that I've explained what the RSI and the stochastic RSI are, I want to talk more about how you can actually trade with them. And in reality, there's two main ways that you can actually trade with these indicators. The first one is with divergences, and the second one is trading breakouts. So I've talked a lot about bearish and bullish divergences in my channel, but for this video I'm gonna explain again how they are formed. And for instance, if we look at this graph, this is the GBP USD. If we take a look at the RSI, we see that there is an actual high around here, and we get another lower high in here, but the price is actually going up. So this is basically what you would know as a bearish divergence, because the price is actually going up but the RSI is actually going down, pointing that this price is actually overbought. So as you see around here, the price actually retraces a little bit because it needs a relief. It needs to correct from this price action to the upside. But now if we continue looking at what the RSI is doing, the RSI actually goes up again, but in relation to this first high, we see that it's again a lower high, and the price action is actually an even higher high, so you will have an even more overbought position around here. And if we take a look again as a validation method, the stochastic RSI in both cases is at the top, meaning that it's also overbought, and this means that the momentum to the upside might actually be over, or it's actually gonna be turning around. So this is a perfect opportunity as a setup to say, hey, here the price needs to correct a little bit. We have this bearish divergence, and we also have this stochastics in the overbought position. And again, here in the second divergence, it's the same scenario. You have the price actually moving to the upside, and you have the stochastic RSI at a overbought position, meaning that this could potentially be a good setup to actually take a short. And as we see, the price actually corrects itself, goes a little bit back up, and then finally dumps greatly once again. And usually this really depends on your strategy, but in my experience, divergences will always tend to go to the first point of action. So for instance, if we have the divergence forming from this point around here, the price will tend to find that point again to correct itself. So now I just wanted to show a trade in the other side, in the oversold position in here. So again, we have a divergence forming in the RSI, we have a low around here, and we have a higher low in here, but what the price action is actually doing is going lower here instead of higher. We also see the stochastic RSI in here. We validate it because it's oversold in the first peak, and in the second it's oversold as well. So you would be likely to take a long around this level, and we see again that the price is actually goes up. And as I told you, usually you would go and correct at the very least to this point, but we see that the prices actually go further. And this is what is called a bullish divergence, because it's a sign of price exhaustion to the downside, which means that you could potentially have a movement to the upside. So now that I've explained what bearish and bullish divergences are, another way of trading with the RSI and with the stochastic RSI is actually trading breakouts. And just as price action, you can actually trade breakouts when you see that there is a certain channel forming, or that there is a level of resistance or support forming in. And I have talked about this before in my channel, and you just apply that knowledge into the RSI. I personally don't trade a lot with this because there's a lot of false positives that you can encounter. So for instance, in here you can see that the 30 level forms kind of a resistance. So whenever you have the price actually going down, for instance in here, you can wait until it breaks this level to the upside, and you will see that the price actually gonna follows up, at least in this scenario. And you can do that with the RSI. For instance, you can grab in here, let's say we have a resistance around here. We see that the price is actually trading within a certain range, and just as the price action, you can actually trade with this around here. And again, you see that the price is actually moving with this range. But as I've told you, sometimes you get a lot of false positives. For instance, in this scenario, you see a breakout, which you can actually trade in here, but in reality you wouldn't get a lot of profit. What you end up seeing in this particular case is that the price still moves, but it's until this point that the price actually really breaks up and it goes into the overbought position, and from here you would actually have gotten a real nice swing to the upside. Then you see again that the price is actually overbought. You check out with the stochastics, it's also overbought, and then the price actually corrects itself to the downside. So this is one of the reasons that I don't really trade breakouts in the RSI, at least for the shorter period of time, because they are not as reliable as longer time frames, and they present a lot of false positives. So the last thing that I actually want to talk about is about the different time frames. And as I told you before, this is gonna directly affect these indicators, and the reason is because their input is basically given by the candle and by the time frame that you're giving it. So for instance, in this particular scenario, we see that in here the price in the RSI was actually overbought in this scenario, but that might be different for the higher time frames. So you always have to check the difference in there. For instance, in here we see that actually we are also having an overbought scenario here in the 4-hour chart, which actually gives you more reliability to actually trade to the downside in this case, because you know that not only it's oversold on the 1-hour chart, but it's also oversold on the 4-hour chart. And even if you go even further to the daily chart, you would see in the same scenario that here the price actually barely touched the 70 level, so it became oversold for a brief amount of time. But again, you're aligning all of these indicators with all the time frames. Even in here you can take a look at the stochastics. It's also overbought. You have an overbought territory here in the RSI, so a trade to the downside would only be logical because you are having the same in all these time frames. And for instance, in this particular scenario, if you go to the 4-hour chart, again, as I've mentioned, you have a bearish divergence here, you have a decreasing RSI, but here the price is actually going up. And as I mentioned, just to validate, the stochastic RSI is actually overbought in the first peak, but then when it goes back down and we have this peak again, we have again overbought stochastic. And again, I wouldn't be actually selling on the second peak, because you could say that this is still a divergence in the middle, but this is why you need the validation of the stochastic, because you know that there is still momentum to go to the upside. But once that you get into the overbought territory, you can actually sell, and a good trade in this particular scenario would be around here. And if you wait to the downside, the price actually corrects itself. And if you look here at the longer time frame, the price actually goes even lower. And again, the stochastics, for instance, in this scenario is almost in the oversold territory, so it might be a good idea to actually close your trades around this level. So in conclusions, it's very important that you check the different time frames, because you might have, for instance, a buying signal in the hourly chart, but potentially in the daily time frame you're gonna have actually a shorting or a selling signal. and the reason is because the price moves quicker in the lower time frames, whether in the daily time frame or even weekly or higher time frames. You will have a slower movement of the price, so you have to check them out. And whenever you're having an aligned signal, for instance, whenever you have a overbought 1 hourly chart, an overbought 4 hours chart, an overbought daily chart, that is a better indicator and a more reliable signal than if you have different signals over the different time frames. So whenever you trade, just check the different time frames and make sure that they show the same trading signals. So in any case guys, I hope that you enjoyed the video, and if you did, and only if you did, mind subscribing and also push that like button. You already know that I'm active in other social media. I got an Instagram account where I put all the highlights of my videos, as well as more posts on entrepreneurships and stories about the financial markets. Also remember that I got a Discord server where I put all my trading setups for free, and you can actually reach me in there. But in any case guys, just as usual, I would like to remind you all, stay smart, stay bold, but most important of all, stay cheeky. Take care guys.